Yo, what's going on YouTube? Welcome to another video. In today's video, I wanted to fire back a little bit at some of these YouTubers, more specifically Jeremy LaFay with Financial Education, who just released a video yesterday saying 7 stocks that he's buying heavily right now. And again, I think it sets a very bad habits and very bad precedent for a lot of investors who do not have as much money as these big YouTubers. Now, you can easily fall under the impression that just because stocks have fallen so much, just because the S&P is down about 19%, just because a lot of these small cap stocks are down 70, 60, 80% from their highs, means that they've got to be on sale and it makes sense to buy them now. But in this video, I want to present to you guys some actual data and real proof of why stocks have much further to fall. So let's just go ahead and get right into it, because I want you guys to be protected, right? You know, we don't all have as much money as these big YouTubers who are making 50,000, 80,000, 100,000 about whatever they're making from their courses and their YouTube channel. So I just want to actually come out here and look out for the average person, you know, the person who's got maybe a couple thousand to their name, maybe 10,000, maybe 20, whatever, a small amount compared to some of these bigger people on the YouTube platform, right? So here we go. Let's get into the actual data of why I strongly believe that stocks have further to fall, right? So first, we got the recession stuff, right? So new single-family home sales dropped 16.6% in April from March. This is the 4th straight monthly decline and the biggest month-over-month decline since 2013, which is a clear recession warning for the overall economy, according to several different economists and big people on Wall Street, and honestly, even myself. And now, just moving on to the stock side of things, the S&P 500 has returned an annualized 13.88% over the past 10 years. Now, some of you guys might think that's not that great of a return, but actually it is. That is an incredible return, considering the fact that this compares to a 10.6% return from the S&P 500 from the period from 1957 through December 31st, 2021. This is why you hear a lot of people make the argument that we have actually been in a 10 to 13 year bull market, considering the fact that the S&P 500 has actually returned a lot more to investors over these past 10 years than it has from 1957 all the way to 2021, right? So now the next issue that we have is the rampant inflation that is coursing through the economy is a huge negative for stocks. It's a huge issue. As a matter of fact, consumer prices actually soared to 8.3% in the 12 months through April. And then what you also saw was on that day, I believe a week ago, which caused stocks to really sink, you saw Walmart and Target, as well as a few other retail companies, say that their first quarter earnings were hurt by inflation. This is the first time we are starting to hear this, and this is because consumers are struggling to afford products that have increased in price, and that makes perfect sense. Inflation hurts the consumer. You could expect that eventually it's going to start to cut into companies' earnings, right? Now, on top of that, you have the fact that the Fed has lifted rates 75 percentage points starting in March, and a lot more is expected. And what that means, essentially, higher rates basically means that companies pay more to borrow, which damps their ability to invest. Higher rates also make borrowing more expensive for consumers too, and this effectively actually cripples and hurts their buying power. Now, according to Harvard economist Larry Summers, at no point in time in the past 65 years has inflation stood above 4% and unemployment stood below 5%, where the economy did not enter a recession, at least within the next 2 years of that happening. You also got the yield curve inverting, which a lot of people have said that has accurately predicted a recession literally since like the 1950s. Now, it doesn't mean that it predicts the exact time, but normally when the yield curve inverts, a recession normally happens somewhere between 8 and 24 months, which is fitting into this 2-year time period that Larry Summers, the Harvard economist, is saying, right? Now, this is the main reason why I strongly believe that the market will fall lower, right? Going back to 1929, the S&P 500 has declined an average of 36% during bear markets. And this is according to data from Ned Davis Research. You can actually find this in the Wall Street Journal. There was actually an article in the Wall Street Journal where they actually cited this research from Ned Davis, and that just tells me everything that we need to know, right? You know, a lot of people think that this is the bottom, and some people are calling for the bottom and things like that. But actually, if you go back in history, history actually shows that if we are in a serious bear market, which it looks like we are, then stocks have much further to fall, considering the fact that going all the way back to 1929, which is almost 100 years ago, the S&P 500 has declined an average of 36% during a bear market, not 20%, but 36%. And if that's the case, and if that's just the average, that means we have a lot further to fall. And so the point of this video is just to offer some clarity. I know a lot of people are going to say, oh, you're a bear, you're so bearish, you're so negative. I'm really not. What I'm really trying to do is be objective, be honest, and pay attention to the data that I'm seeing. I am normally not negative or bearish. I am actually normally bullish and optimistic for stocks. Now, I think stocks will continue to soar in the long term. I think 10, 20, 30, 40 years, stocks will do fine. They will set new all-time highs. But I think for now, within this next year or two, I think you're going to see a lot of pain. And I think the biggest mistake that retail investors can make is putting your hard-earned money into stocks too early without paying attention to both history and macroeconomics. And that's the mistake that I don't want to see you guys make. And that's why I went ahead and made this video. So hopefully this video helped you. Thank you guys so much for watching. Hopefully you guys got a lot of this. And if you did, feel free to like the video because it really helps the channel. And yeah, thanks so much for watching. Feel free to like, share, and subscribe. And I will see you guys in the next one.